There are two assets being the best hedge against inflation. And who are they? They are the stocks and the commodities, especially the precious metals. So, how are they performing so far? Who is the real winner? And how about if inflation persists? Between the stocks and precious metal, who will perform better in the near and far future? And why? Now, so this is what we're going to discuss today, the content. First, we're going to discuss about some background between the two, the stocks and the precious metal over the last 50 years, the last 20 years, and the last 3 years. And later on, we're going to discuss about the market outlook for both the stocks and the precious metal if inflation persisted. And towards the end, I'll explain to you the two key reasons for gold to keep rising. But before that, let's take some time to read into the disclaimer down here. All right, let's take a look at their performance between the Dow Jones and the gold over the last 50 years. And we could see that between the two, both of them have the lowest point in the 1970 and the recent years, their all-time high. Both their performance are quite similar at about 5,000 or close to 6,000%. But to be fair, I would feel that the Dow Jones may perform better. Why? Because not forgetting that for stocks, there's still dividends payout over the years. But if we're going to take a look at the capital gain solely, and I would say that over the last 50 years, and it's pretty much expected that inflation will come, and I'll explain to you the reason very shortly, that both of these two assets, which is the stocks and the gold, perform exceptionally well. So on this first point, I would say that it kind of proven that these two types of asset class are the best inflation hedge instrument. Let's take a look at their performance over the last 20 years. Now, if you belongs to the X-Gen, the mega bull of all stock market started after the dot-com crisis, somewhere around the year 2000. And we could see that the Dow Jones over that period until its recent high has rallied 413%. And so is the gold. We saw that the lowest point was in 2001 at 254, and the recent high at 2075, it was 717%. Now, both is a good hedge of inflation. But I would say that I've got to give a little bit more credit to the gold. Why? Because between 700% and 400%, gold has outperformed the stock market of 40%. And the reason why is simple. Now let's look at this chart because inflation is intended. Now, if you look at most of the central bank, now let's turn our attention to the Fed, that every year they want the inflation to be at around 2%. Now, why is it so? Because with the ever increase of money supply, or maybe QE, or printing of money, now they are all referring to the same thing. With that, a printing of money, there's a dilution of currency. With a dilution of currency, inflation will happen. Now, with inflation, these two assets will continue to grow. And especially over the last 20 years, as we could see that in the year 2000, it could be because of the war, the debt need to be increased. And after around the 2008 crisis, QE is implemented, and we could see that gold have appreciated much more compared to the stock market. Let's examine their performance over the last 3 years and what happened to the year 2020 in January. It is a start of the pandemic. Now let's look at Dow Jones. And at the start of pandemic, we could see that the market entered into a deep dive and followed by a recovery, and then it entered into a volatility. And not so much for the Dow Jones though, but for NASDAQ, especially NASDAQ and S&P, it was a period of great volatility over the last 3 years. And however, for the gold, let's take a look at the gold here, is that when the pandemic started, gold holds steady, and after that it entered into a range, and today it's still holding very steady. And I'm going to do this is that I'm going to draw a trend line from here, and we could see that gold generally is behaving pretty well, still in the uptrend, whereas for the stock market is entered into a period of great volatility, and even for today, Nasdaq have not quite recovered yet, although Dow Jones is pretty much encouraging. And for this year moving forward, what are the two main worries for the market? Number one is inflation, and number two will be recession. And with the ongoing inflation and the threat of possibly recession, now comparing between the two markets, what would be their performance like? Now, I would say that the stock market moving forward is going to enter to a period of uncertainty and perhaps greater volatility. I'm not exactly sure it's going to continue to trend up, but with these two elements in play, inflation and possible recession, highly likely the gold is going to continue to move up from here. Now let's look at this very interesting market behavior. We could see that the gold has been testing around 2000. Now I'm going to draw a resistance line somewhere around here. Now it have tested once, twice, probably coming close to 3 times, and we could see that there's this ascending triangle. And again, with these two elements in play, inflation and possibly recession, ultimately I believe that you'll break this 2000 and will continue to move up, whereas for the stock market it will enter into a period of greater volatility. So what would be the market outlook if inflation persisted? I will try to avoid the stock market because looking at it, the way it is, the stock market likely to be very volatile. But however, for the precious metal market, the commodities, there's a likelihood they will continue to trend up. Now, on that perspective, I have two portfolios, one for the long-term investing and one for the short-term trading. Now, for the long-term investing gold, I'll have about 10% of my net worth. I have some physical gold and some paper gold with some funds, ETF, and some mining stocks, especially those that pays dividends. Then for the trading part, since I know that likely is going to continue to trend up, I'll be applying this strategy. I'll be always constantly looking out for buy on dips strategy. Whenever the market decline, but knowing that it's on an uptrend, continuous uptrend, I will look for a potential dip and focus on the buying opportunity when it arises. Now let's take a look at how this can be done. And what we're seeing here is the monthly chart of the gold. And in the previous videos, we discussed about how to draw an uptrend line, and we discussed about the primary and secondary uptrend line. I will share the link below. You can revisit all this past tutorial. Now, if I'm going to drill a little bit deeper, I'm seeing that market may correct slightly over the short term. And that's what I mean by once we know that the long-term trend is still up, I'll adopt this strategy of buying on dips. And how exactly I'm going to do that is this. And let's look at the daily chart. And daily chart, I've drawn this uptrend line, and we could see that the last few days, especially this guy here, you have broke below this very short-term uptrend line, and I'm expecting the next few days. Now, this is a daily chart. The next few days, market may kind of ease off. What I shared earlier is that once we're able to recognize the main trend, look for an opportunity to buy on dips. Now, let's look at what happened to the monthly chart, and that's what I'm seeing here. As the next few days, as it come down, and this is a monthly chart, it may come to around this point. I will eyeball like a hawk to see if there's any buying opportunity. For investing, we'll look at assets like the physical gold or the paper gold like the unit trust or the stocks. However, for this example, we are trading into the gold, and of course I will deploy derivatives. And what we're seeing here is the COMEX gold. The contract is relatively large. You can explore into will be the micro gold futures, and it states that every 0.1 point is equal to $1 US. It also means that 1 point is $10 US, 10 points $100 US, and 100 point is $1,000 US. It means that fluctuation like this from about 1007 to about 1009, there's about 200 point movement, and the potential profit and loss is about $2,000 US, and that's what we're seeing here. So what are the two key reasons for gold to keep rising? The first key is that with easy money policy, it produces inflation, and it's not going to stop anytime soon. And I do not think that the central bank will stop printing money at all. So therefore, we have to expect that inflation will be ongoing. And the second key, where we will discuss it next week, is about gold. It's not just inflationary hedge instrument, but gold is also a currency hedge instrument as well. Now, some argue that with higher interest rate to come, gold may face greater headwinds because of a stronger dollar. Now, we will discuss this gold as a currency hedge next week. I've included some of the past tutorials relating to today's discussion and its links below. So keep watching it again and again, and you too can get into the markets with greater precision. Always enjoy studying the correlation between the markets, and I hope today's sharing will be helpful in how we invest and trade. Really happy that you have stayed through this video. You have many great trading weeks ahead.